Okay, good evening, everyone. Please, can someone give us an overview of what we did in our previous class, please? This is very important to remind ourselves on what was discussed in our previous class. So please, you can quickly unmute your mic and tell us a brief, just give us an overview of what we did in our previous class. Please, I'm waiting, please. So that means no overview, no lecture, right? Should we do it like
Yeah,
that?
good evening, Mr. Ibrahim. Good evening, everyone.
Good evening.
Uh, in our last class, we were able to explain what exchange rate is, spot rate, and forward rate. We said exchange rate, this is the rate which a currency can be traded in exchange for another currency. That is exchange rate. Then we explain our spot rate. We said spot rate is the rate at which currency can be bought or sold for immediate delivery. So, and we explain our forward rate exchange. Forward exchange rate is the exchange rate set for currency to be exchanged at a future date. So that is our forward exchange rate. Then we move to the need for foreign exchange rates. Under that, I think I'm able to cover up three items there. One of the need for foreign exchange rate is that a company buying goods from another country might be required to pay in foreign currency, such as the domestic currency of the supplier. So it must therefore obtain the foreign currency to make the payments. That is, if there is transaction between two countries and you want to pay your supplier might probably request you to pay in the foreign currency. So I think that is one of the reasons why we are dealing with foreign exchange, the need for foreign exchange rates. Then number two, we said companies selling goods abroad might price the goods in the buyer's domestic currency. That is, you are selling goods abroad and someone in Nigeria wants to buy. The person might price in domestic currency. So there is a need for foreign exchange rates. So number three, we might have a company investing to abroad might need to obtain foreign currency to acquire or take or to make the investment. So that is number third need for foreign exchange. So from that we move to what direct quote is and what indirect quote is. And we said direct quote might be like a company domiciled in Nigeria. A company is domiciled in Nigeria and we want to buy goods in the US, and our currency is quoted, that is the spot rate is quoted as probably 160 naira per $1. So that means the naira, we are spending naira in Nigeria and we are the one buying the goods. So that means that is a direct quote. So we move from another example that it might not necessarily be Nigeria, it might be between Germany and US. That is euro and dollar. So if a Germany company wants to buy goods in the US and the currency is quoted as euro against $1, so that means it is still a direct quote. But in a situation whereby it is indirect quotes, we said we might have a company in the we might say we have a company in the US and a company in Nigeria, and the currency is quoted as dollar against naira. So we said that is indirect codes, and we would devise a matrix to determine our what, to determine our probably value for the goods we want to pay, or the exchange rates. So when it is a direct code, we said we multiply the weak currency by the strong currency. We multiply this weak currency by the strong currency. In a case whereby it is an indirect code, we divide we divide the strong currency by the weak currency. We divide the strong currency by the weak currency. That is an indirect code. And from there, we move to appreciation or depreciation. So you explained appreciation that when the unit of domestic currency to buy one foreign currency decrease, that means we have hence the domestic currency is appreciating. That is when the unit of domestic currency to buy one foreign currency decrease, that means the domestic currency is appreciating. And when it is depreciating, that means when the unit of the domestic currency to buy one unit of foreign currency increases, that is where it is depreciating. So, and you move to foreign exchange risk. So I think in the foreign exchange risk, you explain, you said we should take note of three things that the examiner might say we should explain there. We have the translation risk, we have the economic risk, and we have the transaction risk. The translation risk is the risk that you might have a subsidiary abroad and you want to translate there. Probably we in Nigeria, we have the parent domiciled in Nigeria and want to translate our subsidiary transaction or financials at the end of the year. So we want to translate them to Nigeria currency. So that is where we have translation risk. So there might be volatility in the exchange rates when we are translating. Probably when we want to translate our P or L using the, I think you said the average this thing, and our balance sheets using the closing rates. So, and you explained the economic risk. You said economic risk is when there is probably barriers of probably entry one country. So economic risk might be created. So, and you explain transaction risk. And transaction risk is that when probably you buy goods today and you want to pay in future, there might be volatility when you want to pay. That is transaction risk. And you said there are some techniques for hedging economic risk. You said there are techniques for hedging economic risk. That's where we have matching of asset and liability. We have diversifying the suppliers and customer base. And number three, we have diversifying of nations worldwide. I think that's your response.
Interesting. Honestly, I like your summary, right? It makes a lot of sense, right? Even those who are not in class, in our previous class, they can actually pick one or two things from that summary. On this note, I think I owe you something again. What can I do for you, Toib? Honestly, it is just something that is like a way of showing some like I appreciate your summary, right? Because it makes a lot of sense, right? So I don't know what I can do, but I will reach out to you in your DM, right? We'll talk.
Thank you, sir.
Yeah, thank you so much for this summary, right? It makes sense. So before we continue with our lecture today, we should know that our intensive class we commence on 28th of October 2025, where we'll be looking at the worst case scenario questions that we may see in exam, right? And if you have the resources, you can join us in the intensive class, but if you don't have the intensive so if you don't have the the resources, right, you can still stick to what we have done so far and do a revision. But guess what? It's going to be an interesting class, and you will get, I know you will always get what you pay for. So I don't want to mention value for money and all that, right? So if you have the resources, you can join us in the intensive class, which will come up on the 28th of October. And all lectures, we'll stop our lectures, SFM lectures, a week to our intensive. I think maybe Friday or Monday, we should have round up our lecture under the international investment so that you can have enough time for you to prepare for the intensive class, right? So in today's class, we shall continue with our lecture on I don't even solve this question myself. Okay, we shall continue our lecture on where we stopped on foreign currency class. Like I said in our previous class, there is no how you want to solve international question under international investment without you understanding when it is direct or indirect quote. Please, I would like you to go back to that video and watch it over and over again so that it will really help you in when we get to international investment, because these are the ingredients, these are the things you need to know before we jump into the international investments. Now, in our previous class, I stopped here. I think I stopped at this transaction risk. You know, we have different type of risk. Toyib mentioned, but we have the transaction risk, the economic risk, the translation risk. Now, the transaction risk occur like it happens to everybody, right? Now, imagine a Nigerian company sell goods to US. Maybe the worth of the goods is $100,000, right? So because of the exchange rate as at then, it is a Nigerian company. Exchange rate as at then is 150 naira to $1. It is a direct quote, meaning that we use 150,000 to multiply by $100,000 because that company is a Nigerian company, and you can see that the spot rate is the naira comes first before the dollar. So that should show you that, okay, yes, this is an indirect, or this is an indirect quote, right? Toyib, I don't like mentioning the weak and the strengthened currency because sometimes it may look confusing for most students. So that's why I don't like using that approach, right? It makes sense as well, right? Well done. So now let's assume that the US-based company did not what do they call, pay that money as and when due. Probably the US buyer is allowed to then not give the US buyer, and that's okay. We should not forget under IFRS 18, right? Foreign exchange, right? Is it foreign IFRS 18? Is it IFRS 18 or IS 18? I don't know. Maybe IFRS.
IS 21. IS 21.
IS 21.
Okay, IS 21.
Yeah,
Okay, thank you.
21, yeah.
So IS 21. Okay, that talks about, thank you for the foreign exchange, right? IS 21. Now you can see that what you did in the first one, that you have 15 million, is what we call initial recognition. Is that also initial recognition at when the transaction took place? But the US company, the US buyer, you can give the US buyer a credit, 3-month credit. And if this person paid in 3 months, what will be the exchange rate? The exchange rate now becomes 140. Imagine you giving a credit that, okay, pay in 3 months time, and when the person wants to pay, the exchange rate becomes 140 naira to dollar. That is why in every international companies they have edgers, they have risk management, those who analyze the risk of their credit, because if they buy or sell goods on credit, they have to analyze what is expected, right? Unlike in a banking, in the financial sector, they actually make provision for expected credit loss. right, in line with IFRS 9. Is that also expected credit loss, right? When we get to case study, we'll explain if we have a case that has to do with banking, right? Because I actually did analysis on what is it called, the CIBN. So that is why I said, oh, I remember the expected credit loss for companies or for financial institutions, right? So you could see that the exchange rate is what, 140 naira per dollar. In 3 months' time, maybe March. Now, the company will now receive 14 million. Imagine, oh, if to say, oh, see your goods, or see my money, oh, you would have paid me 15 million. You would have just paid me my money, everybody will go. But because you can give this person credit, then you now give this person credit. In 3 months, bam, the exchange rate becomes 140 naira to dollar, bam. Who is losing? The Nigerian company will lose. The Nigerian company, the 14 million is what we call subsequent recognition. Is that also subsequent recognition, right? Because they've paid you the money and everything has gone. Is that also? Now, what will happen? That is why you will now see foreign exchange loss in your profit or loss account, right? You can see that there is a loss here. At the initial recognition, you have 15. The subsequent recognition, you have 15. You have 14. The difference loss, exchange loss of 1 million, will be debited to the company's account as well. What's foreign exchange loss? It's a loss to them, right? You can see that they've lose money there, and the person that buy, it makes sense to the what? It makes sense to the person, but what about the company? And this is an example of what a transaction. What is transaction risk? Now, we need to talk about the causes of exchange rate fluctuation. Why is our exchange rate fluctuating? We have a lot of reasons why we have exchange rate fluctuation. We have the forces of demand and all this. You can read this on your own to save our time. We have the government measures to stabilize exchange rates. You can also read this on your own when you get your material. So our focus tonight is on the four-way equivalence, or the concept that I explain exchange rate relationship, right? And this part is as important as anything, right? Because this part we still help you in what is it called, in foreign what, in international investments. Now, class, the concept that explains the exchange rate relationship is talking about, we should not forget that the causes, the reason why the foreign exchange fluctuates is as a result of interest rate, it is as a result of purchasing power parity, right? Now, what are the concepts that explain the exchange rate relationship that you may see in the question under the international investment? It may be on purchasing power parity, interest rate parity, the Fisher effect, and expectation. You see the Fisher effect, we've done that under what is it called? Under our capital budget, which is the money cash flow, the real cash flow, the money cost of capital, the real cost of capital. So it has not, so we will not even discuss anything that has to do with the Fisher effect, even the expectation theory. Our focus is on the purchasing power parity and the interest rate parity. And what does this mean, right? So you can see that, let's pick them one after the other. Now, the Fisher effect, you can see the Fisher effect is talking about the money, the real. We've discussed this under the what? Under capital budget. Expectation theory have no effect in our words, in international investment. Now, purchasing power parity, what does this measure, class? The PP states that the spot exchange rate adjusts perfectly to inflation, differentiates between the two countries. Class, you can agree with me that the theory suggests change in exchange rate over time must reflect relative change in inflation between two countries. Class, Class, you must agree with me that your exchange rate, right, over time must reflect the change in inflation. Okay. Let's say the purchasing, in a nutshell, the purchasing power parity is talking about the inflation, how you can adjust companies, how you can adjust countries' inflation in line with what? With the exchange rates. Because your inflation, right, will affect, you have to adjust your exchange rates with what? With inflation. How would that happen? With this formula. The examiner may ask you to calculate the forward rates using purchasing power parity. What it means is that you need to adjust for companies, I say for companies, for countries, inflation rates in line with what? With the exchange rate over time. Class, what does this mean? You have a project, because I'm not in international investment. I'm just looking at it in that perspective, right? You have a project for 4 years, and this project is in between Nigeria and US. Now, how do we do this? Or let's say the functional currency of the parent is in Nigeria, but you have a project to carry out in the US. Maybe the project is for a capital investment. Maybe the project is for 4 years. Class, if this project is for 4 years, what do we do? How do we determine the forward rate? Of course, on the long run, you have to convert it to the functional currency of the parent company. How do we determine the forward rate? Now, when in a question, you are given that the purchasing power parity or the inflation rate of the two countries is given as follows. You should know that what you will use to determine the forward rate is purchasing power parity theory. We state that you must adjust for countries' exchange rate with inflation, because when you are projecting what will happen, when you are projecting your forward rate in the future, you have to consider inflation, right? You have to consider your what? Inflation in your projection of the forward exchange rate, meaning that you have to adjust for it. You have to adjust for inflation in your exchange rate using the what? The purchasing power parity theory. Class. So meaning that it's just like when you are building up a model from scratch and you have inflated, because the project, as a project finance officer, and the project is for 4 years, you have inflated it to reflect your money cash flow or the nominal cash flow. Of course, you know that you should use money cost of capital to discount, and you have so you can see that you need to adjust to get your money cost of capital. Is that not so? By adjusting it with what? Inflation. The same thing applicable here is when you have the exchange rates, you have to use the inflation rate between the two countries to adjust, to determine, to adjust for the what? The exchange rate using the purchasing power parity. So when you are given in an international investment question, when you're given a question and you see that, they give you that, the project is for 4 years, blah, 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 and the inflation between the two countries. They will not even use the word inflation. They can tell you that the purchasing power parity between the two countries is 20%, 15%. You should know that, yes, this is an inflation rate, and you need to adjust it with the exchange rate given to you in the question, right? So now the question is, how do we project, how do we determine the future rate using the purchasing power parity? Now, this is it. Can you see it? So the forward rates will be equals to a minute. I want to check something. Okay. Okay, still the same thing. Okay, so the forward rate, right, will be determined using the purchasing power parity. You can see the two formulas. Use the one that works for you, right? SO is a spot exchange rates. That is the spot rates, exchange rate, right? That is the form what? Exchange rates. Is that also? SO, where SI or FR represents the spot exchange rate at the end of the period, or the forward rate, where FR, not financial reporting, is a sports exchange rate at the end, which is the forward rate. Class, remember this thing that I said, when you have 4 years projects, you have to determine the forward rate using either purchasing power parity or the interest rate. We'll get to interest rate parity. This is just purchasing power parity, which measures, which states that you must adjust your exchange rate with inflation of the two countries. Now, inflation over the period, which is ID in a domestic country. Now, one of the problem here, you have to make this subject of the formula. You have FR, okay, we can quickly make it the subject of the formula. We have FR. How do we do it? Okay, we have okay, we can cross multiply to this. We divide both sides by I plus IF, we'll get our forward rate. Is that not so, class? Is that not so, class? Am I the only one in this class?
Yes, sir. Noted, sir. Noted, sir.
Okay. So we can make subject of the formula forward rate equals to, can use that, right? Okay, that's fine. So now the problem here is, which of these, how do we identify a domestic country or a domestic currency? Let me use currency, a domestic currency. How do we, that is the major problem here. Which one of this is the domestic currency? They give you, the examiner gave you the inflation rates of the two countries. They give you 17%, 18%. Which one of this is the domestic currency or country? Which one are we going to use? There are two approaches that you can use to determine your domestic currency or domestic country, right? There are two approaches, right? I can say the first approach here, then the second approach later. Is that not so? The first approach, I will say it here, right, in class. Then the second approach will be later. Is that not so, class?
Yes, sir.
You say yes, sir. Okay.
I
What if
believe,
I
sir.
forget? If I forget,
Yes, sir.
Singo?
No, take the class, sir.
Okay, that's fine. So now, the first approach, if you want to determine which one of these is a domestic currency, there are two approaches. Now, the first one is when the domestic currency naira in this case is not part of the two currencies given in a question. The currency with direct code should be treated as a what? As a domestic currency. I've given an instance in our previous class. When the spot rate given to you, class, the spot rate given to you, you have Nigerian currency is not there. And the currency you are dealing with is like euro to dollar. And euro is the functional currency of that company. Can you see? The euro will become the domestic currency, meaning that you have to check for the inflation of the domestic currency of that functional currency given to you in the question. If you have euro to dollar and the company in question is a German company, which is euro, right? And the question is, and you see that you have euro to dollar, meaning that the euro will become your domestic currency because it is a direct quote. Why? Because the country itself, right, where the company is situated is in Germany. Right? Now, in another case scenario, right? In another case scenario is you check for the currency that is depreciating. You check. From the spot rate, we should not forget this. That depreciation of currency is very important. And the appreciation of currency is very, very important. In the spot rate, you see, when you check the spot rates, and you see that the currency that is very high, you see that that currency is weakening. You can see when you see that when you see the spot rate is very high, you look at it that that means the country currency is weak because that country currency is depreciating because the exchange rate is higher than the foreign. Can you see? There are two approaches you can use. The first approach, you can use your spot rate to determine if you have a spot rate, you have euro to $1, and the company is a German company, and euro comes first. So, which means that euro will be your domestic currency because it is a direct quote. In another case scenario, you can use the spot rate, whether it is weakened or strengthened. That is the language we will see under the international investment. Weakened or strengthened. Now, when you look at it, you now see that the currency that is very high in the spot rate, it means that that currency is depreciating, is weakening. And the other one is strengthened because it has power over the other one. Then you can see that this country currency is a domestic currency. But in the case you have Nigerian currency, you have a Nigerian currency will be the domestic currency. Will always be the domestic currency. Right. So that is my explanation. Please, you need to understand this. Now, illustration one. Illustration one. illustration 1. If the current dollar to euro, class, are we still together? Are we still together, please?
Yes, sir.
Yes, sir.
Okay, that's fine. And if the current dollar to euro spot rate is 1.8500 and inflation rate as follows. And inflation rate as follows. Can you see? Inflation rate is talking about the purchasing power parity, right? Because the purchasing power parity is measures inflation. Use inflation to adjust for the exchange rate. We're given the inflation of the two. You can see that Nigerian currency is not here. You can see that you have this, and you have dollar to euro. What it means is that the dollar will be 1.8500 to 1 euro. That is what it means. And using the purchasing power parity, PPP, estimate the 1 year forward rate, the 2 year forward rate, and the 6 month forward rate. Plus the 1 year forward rate, the 2 year forward rate. This will help you a lot under when we get to international investments. We will do forward rate, either using the purchasing power parity, depends on the examiner, then is inflation, or the interest rate parity, that is IRP. We'll get there. Now, my question now is, how do we identify? What is the formula? Suggested solution. What is the formula for calculating the forward rate under the purchasing power parity? I can change this. We can have, I can just go straight. I can have FR mathematician Mukuna. FR, I will just use this. I will just get my, instead of doing that long things. I can just use it like this. I will have one, all brackets, 1 plus, wow, not working here. So I don't want to stress myself. Since it is just 1 year, 1 plus IF, all brackets, this, so I can have 1 plus ID class. So I can have this to this. Can you see? But because although this is just for just 1 year, of course, when we get to 2 years, we will see how we'll raise it to power. But when you want to determine,
This cross multiplication is not correct, though.
Exactly. ID is supposed to be up.
ID is supposed to, yes. ID is supposed to be up. Then the IF will be
Down. Yes, sir.
let me check. need to confirm. Okay, ID. Okay, there's the way we did it. Let me check something here. Okay. ID will be up, right?
How did
Yes,
you
sir.
down? How did you down?
Now,
Wait, I
you
mean,
know,
This type
so like
this is the
if you
standard
cross
formula.
multiply,
If they cross multiply with process, we should just forget it. This is the standard formula. If the cross multiply with process, we should just forget it.
okay, should we go back and do the analysis?
well, it's based on the formula that you wrote to like making FR the subject of the formula.
Yes, actually.
Okay.
So if we let's
Okay.
just do the cross multiplication, you will see that the ID will be down. I mean, IF will be down.
Okay. I actually get your point. I get your point. I get your point. Zero.
Or is it Babel's theory?
No. I'm thinking of something now. Something just came to my mind. Okay, let's move on. Let's just okay. Interesting. Okay, let's just move on. Let's move on. So we have this. We can correct ourselves as we move. Probably maybe on Saturday. Let's move on. So if we have this, right? So it means that dollar is 1,800. That is what it means to €1, right? Now, and we're given the inflation rate to be this. Now the question now is, which of this is the domestic currency? We should not forget that, because they just give us question, we don't know the functional currency, we don't know the country that actually owns it. Is it the first one or the second one? Fine. And I said, in another case scenario, you can use the spot rate to determine a domestic currency. That is, check for the spot rate that is weakened, or that has the highest spot rate. Which of these? You can see that this is dollar to euro equals to this. What it means is that dollar is 1.8500 to €1. That is what it means, class. It means that dollar to €1. Dollar is 1.8500, while euro is what? Is 1. So which one of these will not be the domestic currency, class? Which one of these will not be the domestic currency? Which of these will be domestic currency?
Dollar, sir.
Dollar.
Okay. Because you can see that the currency is very high, right? Very high, right? So now, can you see? So you can say it that this is domestic. Why this is why this is what? Why this is foreign, right?
Sorry, Mr. Ibrahim. Sorry, sir.
I'm still
So
coming.
in this
I'm still
scenario,
coming.
can we say dollar is
I'm still coming. Let me finish. Thank you. So if you have this, you can see that you have 1.8500, which happen to be the domestic. Then you have Evo to be 1. You can see that when you have this, you can see that you have this dollar to Euro. What it means is that dollar is 1.8500 per 1 euro. Right? You can see that this is higher than this. And then they give us that, okay, the country is this. We can now know that, okay, we can use that country to also determine which of these is what is domestic, because from the spot rate, we'll look at it, right? We'll look at it from the what? From the spot rate. Now, we cannot have ID or IF, which is inflation rate of the foreign, to be 4%. We can have ID, inflation rate, to be 6%. Right? So we can now have the SO, which is the spot rate. And what is the spot rate? 1.8500. So we can move it here. Okay. So we can move it here to have IF. Since it's just for 1 year, 0.04. ID, 0.06. What do we have? Spot rate, 1.8500. This is not given, right? We can have we can have 1.1. Then this is 1. So when we cross multiply, what do we have? We can have what? 1.04 FR equals to 1.8500 times 1.06. Right? So 1.04 FR. So when you multiply this, what do you have? Hello?
1.961.
1.961.
Please verify. You another person should please verify.
Sorry, class. I can't say Mr. Ibrahim. Am I the only one? Sorry.
I can't hear him too.
Okay, so please can you hear me? Hello? Please confirm if you can see my screen.
Yes, sir.
Okay. That's fine. Okay, thank you. So what do we have? What will be the forward rate for 1 year? What will be the forward rates? If you divide it, what do you have?
I got 1.8856, sir.
1.8856.
Yes,
Is this correct? Please confirm. Fourth
please
decimal.
confirm.
Yes.
Fourth decimal. Right? So this will be the forward rates. Right? Now, let me explain something again. Oh. This is question given to us. Let's say this is for A. 1 year forward rate. Class. The principle to identify the domestic currency where Nigerian currency is not there, right? It's not among this currency. It's not among at all. It's not among this currency. Is the currency with the direct quotes will become the domestic currency. That is one. Or when you have a spot rate, look for the currency that is weaker. Weaker means the spot rate of the currency that is higher will become the domestic currency. And if you look at this question, you can, if you like, say the question, when you look at it, say, oh, this is a direct quote. If you like, you can say, okay, you can name it like that, oh, this is the direct quote. Fine. Meaning that the currency with a direct quote will become the domestic currency. Or you can even say, oh, I didn't understand it like that. Where is the spot rate? The dollar / euro, it means that dollar is 1.8500, which is very, very high compared with euro of 1 euro, right? So therefore, The dollar is the domestic currency, while euro is the foreign currency, because the dollar is very, very weak. So therefore, we use this to determine the forward rate for 1 year. This is just for 1 year. The inflation rate 4% is for 1 year. And we arrive at, always put it in 4 decimal. You have this 1.8856. Remember that in international investment, you will know that this is, you will even say it that, oh, this is the direct or this is indirect, because based on the functional currency of the company you are working with, right? And this is our answer for 1 year forward rate. So if you have questions, quickly unmute your mic before we move to the next one, which is 2 year forward rates. Quickly. Question? Are we good? Are we good? Ask question now. Toib, you want to ask me question that time?
Yeah, but I think what's in it. I wanted to ask if we can say dollar is appreciating now with what you explained in the last class.
That dollar is appreciating?
Like dollar appreciates in the sense that a unit of the domestic naira, like
I'm with you. Hello? Hello, can you hear me? Hello? Okay. So, Toib, you are mixing its place. We can't say dollar is appreciating. It's actually depreciating. Can you see that you have 1.8500 compared to $1? And you said it's appreciating? How? It's just like when you have 1,500 to Nigerian currency with dollar of $1, you have 1,500 to $1, and you said Nigerian currency is appreciating. How now? Within that two currency, Nigerian currency will become the domestic currency because the spot rate is higher. It's depreciating than the other one, right? So it is what it is. So next one, we have the B part of the question. The B part of the question says the 2 year forward rate. The 2 year forward rates. Class, this is just 1 year, because this is what you will use to convert whether to naira or to dollar. Depends on the country functional currency. That forward rate, that is what you will use to convert. You see, in international investment, it's just that conversion that is the major problem. Any other thing, you understand everything. I assume that you understand everything there. The only thing is the conversion. International investment is your normal capital budget. The only difference between the normal budget and international is because you are extending your investment to foreign countries. Also, and you need to convert. It's just like when you have subsidiary in Nigeria and you have parents in Nigeria, you have subsidiary in the US. When you are bringing the currency, the account of the US, you have to convert it to the functional currency of the what? Of the parents, right? So now, the 2 year forward rates, I will just go by the 2-year forward rate okay, let's test something here. I like to test something. Let's do it like this. Let's go back. Oh, okay. Let's do something. Okay. I have. I saw.
I got 1.815 with this formula.
1.815. 1.815.
Yes.
With which formula? This?
The one you want to write now. Yes.
Okay, the one that I want to write, right? Okay.
So I think the ID should be up while IF should be down. It will give us the same thing.
Okay. Just hold on. Come, let me test something here. Okay, let me don't waste your time. I will do that personal, right? I'll check it out. Check it out. But it is what it is. To give us the same thing. It must give us the same thing. It must. It must. So now let's quickly go ahead, right, with our formula, right? Then we should not forget that we want to estimate. Where did I even pick this question itself? Let me see. Where did I pick this? I don't know. Okay, let's say for 2-year forward rates. Okay, for 2-year forward rates, let's say forward rates equals to, well, this is not working. Forward rate equals to SO. We have 1 plus keyboard. IF raised to power of n divided by divided by 1 plus ID. Class, are we there? So now, because our forward rate is for 2 years, class, because our forward rate is for 2 years, of course, 2, you have to raise it to power 2, because this is just 1 year, and that's the reason why we just do it like this. We have 1.8856. But if it is for 2 years, of course, you have to indicate. For instance, you have a project for 3 years. The first one will be for year 1. This will be for year 2. You can even use this for your year 1. Raise it to power of 2. It will become your year 2. Raise it to power of 3. It becomes for year 3. Raise it to power of 4. It becomes what? Year 4. So in determination of forward rates for 2 years, in determination for forward rate for 2 years, you have to raise it to power of the numbers of years. So I can change this to be forward rates. I already know my domestic. What is the spot rate? I already have 1.8500. Then what is the domestic inflation rate? What is the foreign inflation rate? What is the foreign inflation rate, class? What is the foreign?
1.04. 1.04.
Foreign is 0.04. Toib, I think your network logged you out, right?
Yes, yes.
I actually explained something, so maybe
Okay.
you can check it.
Yes,
You can check. Okay. 0.06, right? This will be raised to power of 2. We have 2, right? Now, so what we need to do first, let's pick it one after the other. Divide 1.04. 1.04 divided by 1.06.
Maybe please that raised to power 2. Is it for the whole of the both
That is why I said.
denomination?
That is why I said, do it this way: 1.8500 times 1.04 divided by 1.06. What do you have? What do you have? 1.04 divided by 1.06. Quickly, what do you have? Away.
0.9811.
0.9811.
0.9811 raised to power of 2.
0.9626.
Okay. FR. Okay, the final answer, right?
No, raised to power 2. 0.9626.
Okay. 0. 0 point what?
9626.
9626.
So the final answer is 1.7808.
1.7808.
7808.
So this will be the forward rate for 2 years. Now, what did you observe from the forward rate of first year? What happened to it? What happened to it? The currency, yes, the currency has actually depreciated. Is that not so? Now, let me show you. When you look at it, you can see that this is forward rate. Is that not so? And the spot rate, what do you have at the spot rate? 1.8500. You can say that your forward rate is at premium. When you see in some literature, they will tell you that, oh, forward rate premium. They will not say, oh, the difference between this and this is forward rate premium. You can see that your spot rate, the spot rate is 1.8500. Then what will be the rate in the future is 1.855, 1.8856 in 1 year. The difference we give the forward rate premium is it makes sense. It makes sense. We have a positive, right? Now, when you look at the second one, so I'm just explaining that part of forward premium though. So we have for 2 years is 1.7808. So what do we have again? What do we have for 6 months? For 6 months, this is for 6 months. 6 months forward rate. How do we determine the 6-month forward rates? We already know that. Let me copy this. Six-month forward rates. Six months. Now, because it is 6-month forward rates and your inflation rate, we already said this is domestic, right? Okay. And your inflation rate is usually for a year, and you have a forward rate for 6 months. 6 months. inflation rate is usually a year, and you're given a forward rate, and you're told that determine the forward rate for 6 months. What you need to do is that times 6 divided by 12. You come here and say times 6 divided by 12. What will be the inflation rate for that 6 months? What will be the domestic inflation rate for that 6 months? Because it is just for 6 months. Class, are we still together? Are we still together? Hello?
Yes, sir. We are together, sir.
Okay. Okay, that's fine. Now, you can see that the first one, let me explain this thing again. The first one is just for 1 year. The second one is for 2 years. The third one is for 6 months. Because it is for 6 months, the inflation is for a year. And we're given that we should just determine the 6 months. We have to divide it. We have to multiply it by 6, divide it by 12. The first one, when you divide it, multiply it by 12, divide it by 12, you still have the same thing. Is that not so? So when you have this, what do you have? When you have this, what do you have? What do you have? Quickly.
The first one, 0.02.
0.02.
The second one, 0.03.
0.03. Please confirm if this is correct.
Correct, sir.
Okay. Okay. So okay, no problem. We'll come. So let's go back to our formula. This is for 6 months. This is for 6 months. It is not for 1 year or 2 years. This is just for 6 months. What will be our forward rates? Forward, this is 0.02. This is 0.03. What is the spot rate? This is 1.8500. So we can have forward rate. When you divide this one, the left hand side, what do you have? Okay, let's do it this way. Let's do this way. Forward rates. We have 1.0 FR equals to 1.8500 times, this is important, let's do it like this, 1.02. So have 1.02 FR. So when you multiply this, what do you have? If you multiply, what do you have?
1.9055.
1.9055. So forward rate is equals to what? What do you have? We divide, what do you have?
1.8681.
1.8.
8681.
1.8681. So we have 1.8681. Okay, if you have question, you can unmute your mic quickly before we go. I think I just have interest rate parity. I have interest rate parity.
Please, I got 1 point. What did you get? 1 point.
1 point what?
Okay. Did not see what you were writing.
Okay.
I did not see it. Yes, sir. Yeah.
Okay.
Sorry, sir. Good evening.
Good evening.
I wanted to ask why we didn't solve 1 year forward rate the same way we solved 2 year forward rate.
You can do it. When you do it like that, what do you have?
I have
Do it like that. What do you have?
1.8150. 1.8150.
1.8.
150.
1.8150. Okay. No, I will
Yes.
check. I will check
And
maybe in our next class.
that's 2 year for okay. I was
Yeah,
going
yeah,
to say
yeah.
that the 2 year forward rate, maybe if you don't want to raise to power, you can use the 1 year forward rate as the SO, and you still get the 1708.
I don't know it.
1780.
I don't know I'm that will use what works for you when you want to determine forward rate for 2 years, 3 years, 4 years. When we get to international investment, I'll bring in some ingredient as well that will add to it. Okay, I'm with you. I'm with you.
I use both.
You said?
So the formula for determine the formula.
I think your network, I can't hear you. Maybe your network, I can't actually hear you.
So can you hear me, sir?
Yeah, I can hear you now.
So yes, sir. I say I use a forward rate as subject formula for that 1 year forward rate. Then I get 1.8151. Then I use direct also. I get 1.8151. So which means that if you are using direct, the ID is supposed to be hot.
Okay, thank you. So if this is 6 months, we have this. So let me quickly explain the interest rate parity before we go. Interest rate parity. Okay, that's it. Okay, before we move to the calculation of the interest rate parity, it is very important for me to actually explain depreciation of currency, right? So in international investment, when you have to determine forward rates, in your determination of forward rate, of course, we'll get there. In determination of your forward rate, you need to also consider depreciation of currency over time. But the question is, how do we determine depreciation or appreciation of currency? How do we determine depreciation and appreciation? There are two formulas here. The depreciation percentage will be calculated as 1 plus ID divided by 1 plus IF minus 1. That will give us the depreciation percentage. Class, in determination of your forward exchange rate, you have 4 years as for a project. You have 4 years for a project, class. In that 4 years for that project, your forward exchange rates, there will be a depreciation. It may depreciate, it may actually appreciate. We'll get to a point where we have to determine the depreciation percentage. And when you want to determine the depreciation percentage, 1 plus ID divided by 1 plus IF minus 1, we give the depreciation percentage. Now, percentage in the value of the foreign currency relative to the domestic currency is, when you want to determine depreciation of currency, we'll get there, is 1 plus ID, which is domestic, divided by 1 plus IF minus 1. We give what? We give depreciation of currency, right? But this, I will check for this. This is not correct. This is not appreciation. We're having the same thing. I will check for the appreciation of the currency, how to determine the what is it called? The formula for calculating the appreciation. But this is for depreciation of currency. This is not correct for appreciation. This is not correct. This. So I will check. Now, another thing you need to know is the interest rate parity. Class, you can also use interest rate parity to adjust for your rates. Is a relationship linking spot exchange rates, forward exchange rate, and interest rate. What it means is that you have to use the interest rate of the two countries to adjust for the forward rate, meaning that they will give you two countries, which is the functional currency, which is maybe the main company, maybe is in Nigeria, and the other country is in what? Maybe is in with what is it called? US. You have to add, for you to get the forward rate, you have to adjust for the interest rate. So in that question, the examiner will say that the interest rate parity of the two countries is this. Just like when we have the interest rates of what we have as of today, right? The MPR in 7, right? No, 24, sorry. So how do we determine the forward rates, right? How do we determine the forward rate? The forward rate is still the same thing, just like the purchasing power parity, right? But the only thing is, instead of using domestic inflation rates, you have to use the what? The interest rates. Can you see? The forward rates and the spot rates, right? Spot exchange rate stated. So when you want to determine the forward rates for maybe for 1 year, 2 years, 3 years, 4 years, you have to use this formula to determine your what? Your forward rate, right? I have a question here, but in our next class, we'll solve the question, which is illustration 2. Well, I still have illustration 3 on how to determine depreciation of currency, then before we move to international investment. My message here this evening is that we have the causes, we have what is it called? The factors that explain the exchange rate relationship. The first one talks about the purchasing power parity, our focus on the interest rate parity. The purchasing power parity states that you have to adjust for inflation of the two currency. your exchange rate should reflect the inflation of the two currency, right? And I gave a formula and why we have to use that formula. Then we look at illustration 1. And Mr. A says, why can't we use that second formula that we use for 2-year forward rate? Mr. B says, we should have turned it upside down. Class, we should not be confusing ourselves. Like I said, like I usually say, you see that short videos that you watch on YouTube, you are just seeing the surface of that topic, the surface, not the real, right? Because ICANN exam has now gone beyond that. Let me quickly prepare your mind. ICANN exam has not now gone beyond. Before we used to have bond, AAAT, duration, maturity, but now it has gone beyond yield to maturity and all that. Now there is forward rate. Is that not so? Before now, we used to have the Black-Scholes model. I can usually state, okay, determine Black-Scholes model, data neutral hedging, all those things. But now we have the what is it called? Intrinsic value of an option. We had it before, but it is not tested, right? That is why I say it has gone beyond that. And so on, and so many changes like that, right? And we have made use of most of them in our previous class. Like I said, I will equally check what happened here. We should have arrived at the same answer, even if we have this formula. But don't change it. Just understand that when you have the box, when we get to international investment, well, I still have some ingredients that we actually need to add. But understand which one is the domestic first, which one is the foreign, so that we will not argue when we get to international investment. So I equally explain the interest rate parity. No, I explain the depreciation. Oh wow. I think we have to go. Okay, I equally explain the depreciation, the formula for calculating depreciation of a currency. Then before we move to the interest rates parity. So in our next class, we'll look at illustration 2, illustration 3, illustration 4. I think I have up to illustration 4 under this before we now move to international investment. So distinguished professional colleagues, I hope I've been able to do justice to this part. So if you have questions, quickly, you can unmute your mic before we go. If you have questions, please unmute your mic.
Thank you, sir.
Okay, yeah, you're welcome. You're welcome. So if there's no question, you're welcome. So if there's no question, we'll meet on Saturday at 11 a.m. so that we have enough time to move to international. Remember, these are the ingredients you need to know. If you understand this ingredient, just forget international investment is gone. If you understand this interest rate parity, purchasing power parity, direct and indirect, these are the things you just need in international investment. But just understand it, how to determine the depreciation of a currency. In our next class, we'll look at all those things. I hope time will permit us. So thank you so much, everyone, for joining, and enjoy the rest of your evening. Thank you.